Hello, everybody. Welcome to Friday, another Talk Money with Tom show. I'm so glad that you could attend with us today. We do this show to try to help people, have a better retirement, especially in the financial arena, obviously. And so we do that by answering your questions. You can send those questions in now. There's an email address to send them to. Ask Tom at talkmoneywithtom.com, or you can put them into the chat if you'd like, and we'll try to answer those live. We've created this channel because we feel like there's kind of a shortfall on, retirement planning and asset management and tax planning in retirement content. And so you can subscribe to the channel if you'd like. Go check out the different videos we have. You can put down the little bell button that you can push there will allow you to get notifications when we put new content on the channel. So you can try that. And then lastly, of course, if you just want to meet with us and talk to Ethan and I, ask some specific questions, you can do that also. We have a book appointment button on our website. The link for the website is here on the channel, and you can see the button once you get to the website. It looks just like that. So look forward to being able to help people today. So feel free to send your questions in now. We have questions that came in. We have questions that came up during our strategy sessions with our clients that we, like to bring up also. So looking forward to that as far as that goes. However, I do like to start off the show with kind of just a breakdown on what I saw happening for the week in the stock market this week. And I do a video every day, Monday through Thursday, on what I saw happening that day. And then this is sort of a summary for what happened for the week. So let's take a look at kind of the overall chart, which we've been looking at here for quite some time. This goes back to 2018. And you can see the market is really, had a big drop in the pandemic and what have you. But the most recent motion that was right above us here has been pretty consistently up, not bad at all as far as that goes. So today is very interesting. We are right on the edge of the all-time high. The all-time high close for the S&P 500 is 6,118, and we're right in there. So we'll see if we can make it today for another all-time high close. I mean, last year it happened, I think, 57, 58 times, It was kind of fun. The record is 70-something, which was set back in 1995. Hard to beat that one, especially, we have a lot of things happening right now. And so let's take a look at some of the things that happened this week just in terms of reports. So and issues. So one of the big things that happened first, was that we were told that on Monday we're going to have tariffs for 25% on aluminum and steel. So Monday rolls around, and actually the tariffs are starting March 4th, and this has been an ongoing thing. So if you go back a couple of weeks, February 1st, that Saturday was supposed to be, we're going to have tariffs on China at 10%, Mexico at 25%, and Canada at 25%. And then Monday rolls around, and the market's down like 2%, and all of a sudden we're actually not going to have tariffs on Saturday. We're going to have them on the 4th, on Tuesday. This is last week. And so one of the things that we're kind of seeing here is that I think that they're kind of announced, and then there's a deadline that's later, and that gives a period of time for negotiation. I think that's what we're trying to get to here.
Yeah, and it's kind of like the boy who screamed wolf, right? You scream wolf, tariffs enough, people will start to ignore it until there's actual action.
That seems to be very true this week, especially, right? So we've only had a couple of weeks of this, and already people are starting to kind of catch on. Now, the tariffs from China are still there, the 10%. It's a little vague. I looked into this and I still can't figure out, is it blanket across the board? Is it certain, products and such too? So we'll find out some more about that at some point in time. But this week, the tariffs again, are pushed off till March 4th for aluminum and steel. And then the other thing, didn't change. Changed here, didn't change there. But we'll be right back. This little technical thing, try to figure out here, just get these charts to work. There we go. We're back. Sorry for the delay. Sometimes the button system that we have to kind of change, it's a very sophisticated setup actually, but it doesn't always work.
Hmm.
Sometimes it disconnects. We practice, before the show, make sure it's working, and then somehow it doesn't. So this is a chart showing like the total, imports coming into the U.S. And then, you can see how small really iron, steel, manufactured metals, non-ferrous metals are. So we're going to put a 25% tariff. That was what's coming at us at the beginning of this week. And the market was actually up pretty much right away on Monday. Didn't really bite on this one, even more so after we heard that the tariffs weren't coming until March 4th at the earliest. So, we'll see what happens in that regards. So there was a lot of, kind of scary press about this because it definitely hurts certain industries. I know the Ford CEO came out pretty against this and talked about how much it would impact the automobile industry and what have you. So, because 25% tariffs, that's pretty high. I mean, we're not.
Especially when you're using that as an input, major
Yeah,
input.
yeah, exactly. And so, it's we'll see how that works and see what they do. But again, the market was up on Monday after this was announced, and again, up even more after it was delayed. So, kind of interesting. The other tariff piece that happened this week, we were told on that Thursday we were going to have reciprocal tariffs.
Hmm.
Okay, so that means that like if we have a 2.5% tariff on incoming European cars, and they have a 10% tariff on incoming U.S. cars, that we would move our tariff up to 10% to match what they have, right? And so again, the market was waffling a little bit on Thursday until we actually found out that it wasn't going to actually start until sometime in April. So again, that seems to be the ongoing pattern. Gives these countries a chance to come over and say, hey, let's negotiate and what have you. And so, will we ever have actual tariffs? Yeah, well, we seem to have some on China that were, kept so far. How long will they last? Are they temporary? Is there still negotiations going on behind the scenes that might get rid of them? The tariffs that were put in 2018 are essentially still here.
Hmm.
They were re-upped for the most part by the Biden administration in May of last year. So, you know, and it hasn't been the end of the world. Obviously, we're almost at an all-time high in the stock market today, even with those tariffs still dragging on prices in the economy and what have you. So, I think one of the things we have to be really careful about here with tariffs, especially, or really any of these scary things, we actually don't know what the impact's going to be, right? We don't know if they're going to do them. We don't know if they're temporary. We don't know if they're long term. And if they are long term, we're not sure what the impact actually is going to be. Is it going to be enough impact so that the Federal Reserve starts raising interest rates and starts to, hamper the growth of the market? We don't know all of those things, and so we got to go with the market. You can't really, and this has been our process from the beginning. You can't guess, you can't project what's going to happen, and then try to make moves around that because we've got markets that are running right now,
Hmm.
and so if you're not in there, you're not making that money, and so you got to give the possibilities for almost anything can happen, right? The market could go skyrocketing here. I mean, one of the things about where the market is right now, we have been bumping up against this same level ish, right? A lot. And if you look closely at the charts, the bump has been on the upside of that range and not so much on the downside. To
Yeah.
me, that usually means we're going to break through. And I actually really think we are going to break through. And one of these times we'll break through and really go. We broke through a couple times before and kind of fell back down pretty quickly. But the market is showing strength. There is interest in buying in the market, and the market's coming in. And so I think like what we're seeing maybe today and yesterday, where I saw some good strength, that seems a little surprising to me, faced with all the other things that are happening this week, which we'll talk about some of those other ones. Is that today we're kind of being announced the House has a tax package,
Hmm.
right? I read everything I could to try to figure out like what taxes they're going to cut. The only thing that seems to be clear is that they want to continue the 2017 tax tables.
Yeah.
I've read 10 years, so not infinitely, but for 10 years. That's actually a big deal. If we go back to, if everything sunsets that was put into place in 2017, the average household has a 22% increase in their taxes, which is literally one of the highest tax increases in the history of this scenario. So, that part's there. That's expensive, but are they doing corporate tax? I've seen some, projections, they go from 20 to 21 to 20, or they'd go from 21 to 15, right? So that's probably the biggest one that the stock market will be concerned with.
Yeah. We'll see how they can pay for the tax cuts too, which will be
Oh,
very
what's
important.
in the package right now is really, it's just, they didn't specifically pick out the tax cuts, because this is just coming out of the committee, so it has to get through the House still, and of course the Senate has to deal with it. And the Senate has their own bill in progress that actually doesn't have any tax cuts in it. Those are going to run into each other. So, this will be a little bit of a work in progress. But right now, in the article I read, there was an $880 billion projected cut to Medicaid over a 10-year period. And so Medicaid is now a really complicated animal, and the Affordable Care Act, also known as the Obamacare, has become entwined with Medicaid. And there's an awful lot of, red state recipients, citizens that are in the Medicaid system. Matter of fact, Steve Bannon came out and said, be careful with this, because there's a lot of MAGAers that are using Medicaid. So, we'll see. That's the problem. What's really important here for a tax cut is especially important for the bond market, which is you have to have cuts that would equal, over a 10-year period, the reduction in revenue that could come, or the bond market's going to end up with a much higher, deficit to fund, which then stretches out the bond market and such too. So, yeah, we'll see how that goes through. That came out of committee. I think it was a 21-16 vote, for whatever that means. But we have a very thin majority there in, the House.
I think it's 218 to 215.
Yeah. So are there 3 or 4 people that don't want to see those kind of cuts to Medicaid? Do they find cuts in other places? There's been a lot of stuff flying around. I mean, Trump mentioned about cutting the defense spending in half, and all the defense stocks dropped this week. So, it's all up in the air right now. There's no, this is just kind of like watching sausage being made. I guess there's some analogy there. Sometimes you don't want to see the mess that
we'll have
happens.
till March when I think March 20th or something, 21st is when the budget runs out.
Yes, exactly right. So they're moving along. We'll see. But anyway, that honestly, I think that is why the market's moving, though. That tax package coming out, even in its preliminary form, is kind of exciting the market. We saw this in 2017. As these tax proposals came up, the market started to move, and we had quite a good run out of the signing of that tax package. Now, I'm not saying tax package is great. I'm not saying that I like it or any of those types of things. Doesn't matter. I'm just talking about what it means to the stock market. And the stock market loves reduction in taxes. The bond market doesn't mind reduction in taxes as long as there's identified spending cuts, so it's not going to look like a massive deficit increase.
Yeah, as long as you don't balloon the deficit, bond market's happy.
Right. And unfortunately, I think in the rearview mirror, when we look back at 2017, they said that was reconciled. In other words, they were balancing out. But our deficit has grown pretty dramatically under both administrations.
Yeah, that and the pandemic spending.
Yeah, exactly.
Kind of ballooned the deficit.
All right, so here's another thing that came out today on Wednesday was the Consumer Price Index. So if you look at this is a 3-year chart. You can see kind of right over my head there's a bottoming point, right? Mm-hmm. And it's been kind of coming up. I mean, it's at 3% year over year. So this is looking at January of 2025 versus January 2024, and we're at 3%. Now, again, CPI is not what the Federal Reserve looks at. It is not the thing that they're trying to get to 2%. And this is the overall CPI. And a chunk of that motion upward is the increased cost of energy. But it's going in the wrong direction. Overall, it's down over that 3-year period, but we've had a good 8 months here where we've had kind of slowly rising inflation. I think this is a really big problem for the Trump administration and some of the things they're trying to do. Because the last time we did tariffs in 2018, we didn't have high inflation. Matter of fact, I think core CPI was below 2% at that time frame. And so, we've got this issue of, we're in at least a quasi-inflationary environment where inflation is moving up at least a small amount on almost all of the measures. And we've got a scenario where we're trying to do some inflationary things potentially. I don't know if it'll be inflationary or not, but tariffs could be. Massive deportations of illegal immigrants who work in the agriculture and housing construction industry. could be inflationary for those two categories. So that it's a different tightrope that they're trying to walk here. So if they just threaten tariffs, okay, that won't matter. The market will be fine with that. It'll ignore it, just like you said. If, on the other hand, let's say these mass deportations are really effective, that could be a problem. But if they're not that effective, I just saw an article today saying that for the first month of the year, they had 25,000 deportations. It's actually running at a slower pace than Biden was doing. So, we'll see how it works and what really happens and what is impacted. There's a lot of articles about farmers, because farmers are getting hit from all sides. They cut off U.S. aid. Farmers sell $2 billion worth of food to U.S. aid that gets distributed around the globe. They cut off the infrastructure, the IRA. I forgot what that stands for, Inflation Reduction Act, but I call it the infrastructure bill. So these farmers were putting in big solar panel arrays, and they have to put the money up front, and then they get reimbursed for part of it or half of it or what have you. And so they were out the money and not getting reimbursed because that's all been frozen. Maybe they unfreeze that. And then you've got all these stories where, they'll have a little raid in a particular area of the country, and then all of the farm workers won't show up to work on the crops in that area. So, the farmers are getting, and they're, as a group, they're Trump voters. So, what happens there? How does that get reconciled? In the last, situation, China had retaliatory tariffs against like soybeans. And so all these Midwestern farmers that were selling soybeans into China were struggling. And so they took some of the tariff money and they actually put it into subsidies for the farmers. And so, we'll see what happens there. But here's another measure that came out on Thursday, and this is the Producers Price Index. And you can see pretty clearly, so this is a wholesale inflation. Inflation happens before the retail consumer gets there. And you can see pretty clearly that it's slowly growing. It's not going the right direction. So this is where the market's a little concerned. But the market was up on Thursday, 1%, 1.04% actually on the S&P 500. And so in the face of all of these different data points, the market's moving up, and it's because of this, in my opinion, it's because of this bill that is being worked on in Congress to lower taxes, and the fact that there's one that's out. Whether it becomes the one or not, we'll see. And then this came out today. This is consumer sales, retail sales. And so it's actually down 0.9% over the last month. And so you can see we had 4 good months there of good growth, heading into the end of the year. And it's down. The very first bar on there is actually also a January timeframe. So January can be bigger. People have spent a lot of money during Christmas, right? And so they don't spend as much money in January. And then you get these weather impacts that happen also. So, we'll see how that plays out. But the retail sales aspect has been the driving force, honestly, since this whole pandemic started, as far as that goes. So when we look at the overall totality of things, there's some pieces that are kind of creaking underneath in terms of, what's happening with inflation and retail sales and such. The market is, struggling with the concepts of tariffs, but really quickly here in just 2 weeks has started to kind of ignore, what is happening there, because it's one thing to say, because basically the process that they're using is weird. They say we're going to announce these tariffs on Thursday, and then Thursday comes and say, okay, these are going to start sometime in April. That's what happened yesterday. So, after a while, nobody's going to listen, and we'll have to wait and see what happens as far as that goes. But that's kind of what's going on. It's been really interesting to see. And here goes the stock market. Is it at an all-time high still? Is it up there? Came off a little.
It's 6,115 now.
Well, at 115. So we need to get to over 118 to get. I don't know. Maybe we're in the last half hour. Probably pretty close.
Yeah.
We'll see what happens. Okay. So anyway, that's the summary for the week. It's been a good week to be an investor. I still think the stock market is ready to break out. If it does break out and finally really break out, it'll go. It'll jump, not a lot, 3, 4, 5%. It'll move. And then you'll have this tremendous support right around the 6,100 level on the S&P 500, because we've spent working on 10 weeks-ish, kind of in that same neighborhood, and building up a really big number of shares that are trading in this same spot. So I think that will be a great thing as far as that goes. Anything can happen. All these different things that are out there are pretty interesting. But anyway, that's where we're at right now. So thank you for joining us for the summary, and let's get on to some of the questions.
So, what's going on with the bond market?
Yeah. So it's kind of interesting. Well, I'll share something here. So I have that. Been getting a lot of questions about that from the clients because the disparity, the way our reporting program comes out, it shows, what you made on the stock market versus what the stock market did, what you made on the bond market. The disparity is insane, right? I mean, the stock market's up in the last 12 months for a lot of the clients, I don't know, 10 to 21%, someplace in there. Bond market's up from, 1 to 3 or something along those lines, with the dividends and everything. And so here's the stock market going back to 2018. You can see all the runs. We've been looking at this chart forever as it develops. This is the Vanguard Total Bond Market Index. And so I use this as a gauge of the bond market. It's the broadest bond market ETF out there as far as that goes. And so this is our metric when we're looking at the bond market as a whole. And so you can see that the time frame you don't see here. This actually goes back to 2018, but that big giant bubble was the pandemic. The beginning of that run upward in price and bonds started actually in 2019 when they started lowering rates, and then really accelerated into the pandemic, just because they lowered rates to zero. So when you lower rates, the value of bonds, and this is the value, not the dividends and what have you, just the value of bonds go up. Of course, then we dropped, like right over my shoulder here. You can see this drop, and that was in 2022. 2022 was the worst year for the 10-year Treasury since 1783. So pretty violent drop back down, but it just came back down to where it was before, So it wasn't. So if you look just over Easton's head, you can see that it's been kind of trailing down. Each one of those highs is a little lower than the last high. I mean, that's a primary direction down that's happening right there in the bond market. And so it's completely different than the stock market. And there's some reasons for that. Number one, the stock market doesn't have to sponsor the budget deficit. And so that's a big deal. The stock market looks at the tax cuts, and we're rallying. We've rallied the last couple of days, right? Even in the face of all these different inflationary reports that have come out. And if you look at the bond market, it looks at that tax cut and say, okay, how are we going to pay for it?
Yeah. How am I going to get my money back if I need to do debt payments?
If we reduce revenues by $4.5 trillion, which is what they're trying to do here with this tax cut, how do we save $4.5 trillion? This is over the next 10 years.
Yeah.
How do we save $4.5 trillion over the next 10 years? And what happens is the bond market is the place, especially the Treasury bond market, is the place that they'll go out to essentially, sponsor that. So the bigger the deficit gets, the more bonds that have to be issued, right? And so if you still have the same demand, but you're having to issue more bonds, right? Supply is higher, demand be the same, price will come down, right? And that's the factoring in. And then the bond market is more sensitive to inflation than the stock market. Companies can make pretty good money during inflationary time period. We saw that in 2023 and 2024, record earnings, right? Continued record earnings. We're still seeing it. I just saw a stat today, 65% of the companies that report in the S&P 500 are up an average of 16% year over year on the earnings, which is the best since 2021. And 77% of those companies that reported have beaten their expectations. So earnings are at record highs in inflationary time periods. But the bond market responds very directly to inflation. So these tariffs are going to bother the bond market more. These mass deportations, or the potential for both of these, is going to bother the bond market more. So you have deficits that could be higher theoretically that it worries about. You have tariffs and higher costs because of mass deportations, all of which are affecting the bond market, right? Okay, but here's my look at it, because bonds should be higher. In my opinion, that line should have at least held up, if not continued up, from this last downturn that's just over Easton's head. And so I do think that once they resolve all this, if they can come up with a tax package that looks, acceptable to the bond market, if we really get to see, maybe the second half of this year, what do these tariffs really mean? Are they real, not real, whatever? And what do these deportations really mean? I mean, Are you really going to go in there and hammer the farmers who voted for you? You know, that kind of thing. And
Yeah,
so,
especially because bonds are so sensitive to interest and the Fed's
yeah.
rates.
Yeah, and so there's the theoretically, you get enough interest rate motion. We're already we just looked at those charts in the summary, right? We're already in a situation where the CPI and the PPI are floating upward. Not a lot, but they're not going down.
Yep.
And so, and that's not completely unusual, but it is what happened in the 70s when inflation got out of control after they got it under control and then went back up. So that's in the back of every professional money manager's mind as far as that goes. So, but I think personally that there's a good chance here that these things do get kind of resolved. You'll get used to them enough. We understand what they are. Second half of the year, we could have a bit of a catch up on price on bonds if that does become true. You know, if we don't really have big, massive deficits caused by these tax cuts, if the inflation isn't happening from, you know, tariffs or deportations, you know, or doesn't look like it is, or, you know, whatever it might be, it's possible that we see a pretty good catch up because you should see better rates of return out of the bond market than we've been getting. And I think, you know, averages tend to work out over a period of time. So that's a really good question. It's a really fascinating area to watch right now is what's happening to the bond market. And the bond market could waylay some of these plans. I mean, interestingly enough, everybody's talking about the stock market, but the bond market could really put a pinch on the tariffs. It could put a pinch on the deportations. It could put a pinch on the tax cuts. You know, Liz Truss came into prime minister in England, immediately announced tax cuts without any savings, you know, and the bond market in England froze, right, completely, and the Bank of England had to step in and bail the bond market out, and Liz Truss was out of there in a couple of weeks. There was that joke about what lasted longer, the cabbage in the fridge or Liz Truss and that type of thing. So our market's not going to freeze like that with the same problems because it's a lot more big, a lot
the
bigger.
magnitude of the U.S. Treasury system is much massive.
It is, but it does show you, at least on a small scale, where the risk is to the Trump administration to kind of what we're dealing with here. And so I think it'll be interesting. They're going to have to walk a tightrope because they're in a situation that's already quasi-inflationary, right? And so that's going to make it harder to do what they're trying to do without creating, you know, other problems. All right, what do we have for our next question?
So why has the market been so resilient to all the recent news about high inflation, tariffs, weakening retail sales, and kind of still maintaining close to this all-time high?
Personally, I think the market is looking at this and saying, hey, you know, are they really going to be able to do these things that they're talking about that the market doesn't like? Are they really going to be able to push all of these massive tariffs out there? Are they really going to be able to do these mass deportations? And if not, then the other parts that are good start to win. Because if they're able to do the tax cuts, if they're able to lower taxes on corporations, there's nothing more direct than that. If you're at 21% and you go down to 15%, for example, earnings are after tax, right? So it's an immediate jump in earnings for all companies, which is going to be an immediate jump in the stock market because it relates to earnings more than anything else as far as that goes. And then you've got regulatory cuts. So we've been seeing a fair amount of run in the banking system, for example, ever since the election. I mean, like election day, those have been running. And not spectacularly, but more than the market on a relative strength basis. So it's doing well. And you know what we're seeing there is the potential for decreased regulation, right? And so if they come through and do a lot of decreased regulation, theoretically that can lower the costs. You know, there's disadvantages to all of these that we all look at as people. So don't think we think these are the greatest things ever. We're just talking about what happens, you know, for the stock market. So because a lot of people try to look at the stock market like they would look at things themselves. Well, I don't like that because it's going to cause this. The stock market doesn't always look at
stock market looks a lot about just the pure numbers and
that's
earnings.
Exactly. It's
what
just
affects
about
the bottom line rather than what affects the stakeholders.
right. It's not a socially conscious body of work. You know, it is really capitalism to a large degree. And you know, I mean, it's one of the ways to participate. If they're going to give all these advantages to the wealthy, you know, or whatever the complaints might be, one of the ways to participate in those advantages is to be in the stock market because that's where they're trying to help the wealthy also. And so now not everybody can participate in the stock market, but it is one of the ways to kind of ride along for what is happening, and get something good out of this. If there's other things that you like or don't like, the stock market could be a good place. The bond market, I think, will follow along here at some point in time. We just got to get some questions out of the way. But so anyway, that's what I think. I think that they're ignoring or lessening the negatives, specifically the tariffs and the deportations, and really kind of focusing on the positives, the deregulation and the a possibility of decreasing taxes. Even decreasing taxes on individuals is stimulative to the economy. I mean, if you let the 2017 tax cuts, tax tables that we have right now for individuals sunset this year, you are talking about a 22% average increase in taxes per household, according to the article I read today. And so that would be a drag on the economy, what I'm saying? So it's interesting to see how it's playing out, and the market's looking forward, and I think it's hoping that everything works out as far as that goes. And honestly, the market knows more than you and I do. They know more about what's happening in this tax cut package. Believe me, there is so much money and so much intelligence and so much research. I mean, they use satellites to check parking lots in these retail stores. I mean, you wouldn't believe what's going on. And you don't have to know all of that. Watch the price. The price of the stock market is going up right now and banging up against the all-time high. The stock market is optimistic. You got to look at that and think to yourself, at least economically, you need to be a little optimistic also, at least in this particular thing. So I think that's why the market it's looking forward. It's looking, it's always 3 to 18 months down the road. Mm-hmm. It only reacts to current events. I'd say 75% of the stock market move is that 3 to 18 month thought process, looking down the road. And the rest is something that just got reported, earnings, something that we didn't know about. And there's adjustments that happened for that other 25%. That's my outlook on it. So I think the market, we're more or less out of the earnings season. We still have NVIDIA. Mm-hmm. This would be a big one. Everybody will be talking about NVIDIA here shortly, believe me. So anyway, that's a good question. What do we have? What else?
So what are our thoughts on municipal bonds?
Municipal bonds. Okay, so it's kind of interesting. Municipal bonds, of course, they pay tax-free growth.
So depending on the state, take California example. If you take a municipal bond that's issued by a California municipal, it would be federally tax-free and then state income tax-free too.
That's right.
So there's a lot of tax advantages of municipal bonds, but they tend to pay a lower rate because of the advantage.
Right. Yeah, you have to be in a certain tax bracket to kind of equal out. You got a taxable bond and a tax-free bond. Tax-free bond's going to pay less, but after tax, if you have a high enough tax bracket, you might be making less than a municipal bond.
Yep.
If you have a low enough tax bracket, maybe not. You're still better off in the taxable bond. So it does make a difference as to what tax bracket you're in, as to how that works. But I am been doing this for 38 years, and I'll tell you something I really feel strongly about. Don't invest your money based on tax. I have seen so many people underperform and have troubles because they're trying to do things on tax. So many of the big blow-ups, the limited partnerships, were all about tax. Mm-hmm. They weren't about return. Well, they took away the tax cut, and the return wasn't there. And I've got all kinds of people saddled with these limited partnerships. I mean, I can go on and on. I have clients who have me meet with their CPAs, and we're looking at everything through a tax lens and trying to reduce taxes. And I'll come up and show them, look, the average client in our practice who's not focused on tax just made $100,000 more than you, or whatever it might be, so that you could save $10,000 in taxes. But so with municipal bonds, one of the problems that happens is that, for me, bonds are mostly a safe haven. We make our money on the stock market, so we put as much as we can into the stock market, much as we can afford emotionally, mentally, what your plan says you have to have, whatever it is. And so the rest needs to go someplace to protect that stock market return and to lessen. So you're not putting 100% in the stock market. Where are you going to put the rest? Yep. So I put the rest in cash or CDs and money markets. Well, that's good, except it doesn't go up when the stock market crashes. Okay, I'm looking for something that has a chance to go up when the stock market crashes, and I can still make money on it. So in other words, I could always buy an inverse fund, but I'm losing money during the up markets. Okay, so I don't want that. So bonds tend to fit that category of I can still make some money on it and has a chance of going up. That did not happen in 2022. but
Hmm.
it happened in 2000. It dropped a lot less in 2008. So on a relative basis, it did well. It actually went up in the 2000 downturn.
Yeah, so we were looking for kind of like a diversification against stock market that has
Yes.
some sort of, parachute effect. And municipal bonds can be.
Well, here's what's happened. And if you look back at 2000, you look back at 2008, for example, municipalities were defaulting
Mhm.
on their bonds here in California. San Bernardino defaulted on their bonds. Municipal bonds sunk like a stone as a whole. Now, there was probably some buying opportunities in there at some point in time, but they all got washed. And they didn't work nearly as well as your normal corporate bonds, your normal treasury bonds, and those types of things. So, we'll use municipal bonds if somebody really, really wants to do that. But otherwise, I'm looking, I believe you make money in the stock market. You make money in real estate and the stock market. That's it. You're not going to get rich off of bonds, whether it's municipal or not.
Mhm.
And so you're really splitting hairs there, trying to save a little bit of tax that you'll probably lose all of that gains in the next big downturn.
Mhm.
Because you won't have that offsetting standpoint of the bonds going up or holding up more, and especially if you use a rebalancing mechanism, like iShares, BlackRock did a big study, and when the stock market, when your allocation drops by 5% or more, you're supposed to rebalance. So if I have a 60% allocation and I drop to 55%, I want to rebalance. So what I want to be able to do is pull money out of that bond
Mhm.
market, and I want that to be up as much as it can. It might be down, but be down way less. So for example, the stock market dropped, I think in 2008, 57% from high to low. The total bond market index was down about 10% from its high to low, still came down. But
Mhm.
if I'm rebalancing, I can take some of that money that I've kind of saved in, the bond market portion, and I can buy in at a lower point with the stock. So that's where municipal bonds just, they don't fit in that concept. And I understand what people are trying to do, but I look at total rate of return over the lifetime of that client, and we have had more of these big downturns now.
Mhm.
We had 2000, we had 2008, we had 2020. Three of them here just since 2000 in 24 years, or 20 years technically, whereas they were 35 years apart before that. The Great Depression, the 73 downturn, and 2000 were 35 years apart.
Mhm.
And now we're talking about three in the last 20 years. So I think that's here to stay. The internet moves money quickly. We can create all kinds of products like credit default swaps, sell
Mhm.
$7 trillion worth of credit default swaps in 7 years, and those type of things that can really bring down the stock market in a hurry. So I think that focusing on the stock market and something to save you from the stock market, I think that's where bonds fit in. They're the best I can
Mhm.
see
Yeah.
as a hedge. I'm sure there's something better out there, but it's probably way more complicated and possibly a lot more expensive too. So, okay, good. What else do we have?
So, what is the Social Security Fairness Act? So, this was passed
There
earlier
are the
this year.
targets. I got the slides.
Oop.
The, that's I can do this. The targets if you want before
Oh,
we're
yeah.
done.
So,
Sorry, we have one that I did some slides for, so I want to try to show this.
yeah, what sectors do you see moving right now?
Oh, okay. So yeah, this has come up, because everything's kind of going sideways. Things are, slowing down really since mid-November as far as that goes. We work on a momentum basis. So we have a majority of our assets in the market itself, all the S&P 500, the Russell 3000, the Vanguard Total Stock Market Index, those types of things.
Mhm.
We like that broad diversification. We don't like to try to guess where things are going for most of the portfolio. To the tune of about 75% of the portfolio is in those types of pieces. That seems to work the best, both on the bond and the stock side, because you really don't know. And then we try to kind of get into the margins. And what we're looking for is momentum. Where are things going on a relative basis? Are they exceeding other areas?
Mhm.
And so there's three big ones that have been really good to us here, recently that we still own, and I'll share those. So one is communication services. So this is Meta, Netflix. Those are some of the
A
big
lot of
companies.
your telecom companies are
Yes.
there,
Yep.
and so a lot of those have been doing quite well.
Yeah, that's a really good looking chart. I mean, you compare that to the S&P 500. I mean, even if you look at the, like right over my head there is a little drop. That was that summer of 2023
Yeah.
drop. That looks a lot less than what we saw just on a
And
pattern
then this
basis.
December drop,
Right,
while
right,
the market is kind of trying to get back to that high,
right,
December high,
right.
this has
it's there, right?
It's
It's
broken
through that high. It's broken through. So, and it's had a really nice run from that bottom point there in 20. That's probably October of 2022. I'm sorry that the dates aren't in there, but this goes back to 2018, just like all the other charts. So, that's shown some relative strength there. I saw an article saying Meta was up like 15 days in a row. The stock market certainly wasn't. So there's something happening there that they like. Then financial services. This is Vanguard. There's two financial service ETFs that are really big. One is XLF, which is the Spider series. That is just the S&P 500 financial services, so the big banks. Vanguard is more broad, so it'll have a lot more regional banking in here also.
A lot of the more small cap regional banks in there.
Both are fine, in my opinion, but this one has a little bit more relative strength, has a bit more run. And again, it's in that kind of all-time high area, maybe not as much as the last chart.
Yeah, and this includes like not just banks. It has Visa, MasterCard, all those kind of financial services that we use in a day-to-day.
Yeah, doing well. And then the last one here is cloud computing. Chart isn't quite as strong as those others, but we've got some good purchase periods in here. This is, of course, the big. There's a lot of big companies in here: Microsoft, Amazon, and
a lot of big tech.
Yeah, but this is a really big area, right? Cloud storage and cloud computing is one of the massive things about this one as a whole. So, is Aristonet in here? I think it is. Yeah. Okay. Aristonet's in here too, which is one of my favorite little companies. They got hit with an earnings report, but probably makes them a better buy.
Yeah.
So anyway, those are three areas, communications, financials, and cloud computing that we've seen, relative strength gains. We've been riding those, and that's how we do it. We're not bottom fishers. We're not buying this thing back in October of 2022. We're buying it after it's shown it some strength, and we're trying to ride that strength. And when that strength dissipates, we find the next one that has more strength, and we just keep riding those strong pieces, because basically the idea behind momentum is the body in motion will continue to stay in motion, right?
Yep.
And it seems to be true here with a lot of these investments also, so we can ride these for quite some time. So all right, so we have time for, what was the other question again about Social Security? I think we can finish that.
So what is the Social Security Fairness Act?
Okay, so if you had a pension that did not contribute to Social Security, like a government pension, a teacher pension.
Yeah, basically anything, if you work for a government organization or a municipal or a teachers union, and they did not contribute to Social Security, you would have, and then you got a pension from them, it'd be considered a non-covered pension.
Right. And so you ended up with an offset, and they had these awful acronyms that they used for those offsets.
Yeah, they have government, there's GOP, which is Government Offset Pension,
right.
And then
WAP, huh? Stand for
Windfall Elimination Provision.
Yeah, WAP.
Yeah.
So anyway, they're really complicated, actually. I used to do Social Security seminars, and that was probably the worst part of the seminar, is trying to present that and trying to explain how that works. But they got rid of that.
Yeah.
So they're gone. So there is no offset anymore. So if you happen to have another job, if you contributed to Social Security in some form or fashion, second job before or after you worked for the government or the nonprofit or teaching or whatever it might be, you are eligible now to get your Social Security payments that you would have gotten. I believe it still needs to have the 40 quarter minimum.
You still have to reach the work for 10 years and contribute to the system. But if you did that, you wouldn't have any of these offsets to lower it.
Right.
And this also affects when you inherit Social Security as a spouse too.
Yeah.
Usually, even if you didn't contribute, but your spouse worked for their entire life in the private sector,
right.
Usually what happens is the higher pension or the Social Security benefit would stay.
Right.
But because of the offset, you lose a lot of that. So now the idea is that you would still retain that.
I think that's the bigger area here, because if you worked as a teacher your whole life and never put any money into Social Security, it's not really going to help you, but it might help your spouse, and that would help you altogether, right? Because your spouse might have been in a system where they were getting Social Security, So, and on an inheritance basis, so from an estate planning standpoint, and so it was a bipartisan bill pretty strongly bipartisan, both in the House and the Senate.
Yeah, and the reason there's a lot of support for it is it incentivizes people to not fear going into a career that might not have a non-covered pension. The idea is if you do private sector for 15 years, you don't want to give up your Social Security that you worked so hard, you put money into,
Right.
and then go become, you maybe join the government organization where you're not getting a covered pension.
Right.
And
Yeah.
so,
Yeah. So it allows you to not have to worry about that. It won't be an offset anymore.
and it benefits a lot of people that kind of need the money.
Yeah. Yeah. It was a, we don't get a lot of bipartisan anything anymore, and so usually it has to be something that is really well thought out, and the way it plays out seems fair to everybody.
Yeah, and so the back pay goes to, I believe, January of 2023.
Oh, really? So you
So
can get back pay.
they'll back pay the benefits, and but it's still in the implement. They're still trying to. It's going. They said about a year to implement all
It
this.
take about a year to really get it organized. Okay.
So we don't know if they're going to push it to go a little faster or not, but that's what the current estimate time.
That makes sense. All right. Well, that's our show for the day. Really want to thank everybody for coming, and some great questions today and some good pieces that we've been able to do. So send in your questions. We will not be here next week, but we will be here in 2 weeks. So send your questions in over that 2 week period. Let us know what you're looking at and what you really want to hear about, and we'll try to answer those questions here on the show. You send those again to Ask Tom at talkmoneywithtom.com. Of course, you can subscribe to our channel, hit the bell button to get notified, continue your education in this particular area. And then lastly, of course, is the, possibility, if you'd like to come and talk to us directly, you can come in the office, we can do a phone call, we can do video. Usually it's 30 minutes just to try to figure out what you're looking for and see if we're a good fit for that. And the book appointment button is right on our website. Link for the website's here on the channel. You can go ahead and set that up if you'd like. So look forward to being able to see you guys in a couple of weeks, and we'll see you then. Thank you.